Okay, so let's get started here. Um, Today we're talking about this particular topic that's on, I guess, everybody's mind right now, which is, has the interest rate madness ended, and what is the impact of this on you and on your family? So this is what we've all seen happen over these last 18 months, and it's been kind of crazy to watch. We've had 18 months of just increase. We've had a pause here or there. But for the most part, what we've seen is interest rates jump from, at the retail level, from somewhere at around the 2% range, now all the way up to somewhere in the 6% range for most of us. And I'm sure that a lot of you listening who are mortgage holders are already feeling some pain. And some of those of you who are considering purchasing may be reconsidering whether or not to purchase because of what's been happening in the market. So let's now jump into why you are here. So most people come to a seminar like this, webinar like this, because either you're a first-time buyer or you're a homeowner interested in debt freedom. If you have those things under control, then the thing beyond that for most people is making sure that their family is provided for. And this is not just in terms of education, but also entry into the property market. And then finally, retirement. A lot of us are hoping that when we retire, we're going to have more than just enough to get by. And so a lot of what we do with our clients is make sure that they have a plan in place that is kind of like a supplementary plan in addition to whatever else they have. And in many cases, we've helped clients add $1, $2, $3 million to their net worth by age of retirement. So we're going to cover all of these things today. And in terms of that, we have to look at the journey that we've been on. We're going to talk about the history that we've witnessed. We're going to talk about the current status of the market and the future in terms of, where we see things going towards the end of the year and then in the years ahead. And then we're going to give you some options and advice around what action you can take as first-time home buyers, owners, or potential investors. We're going to cover these key hot topics that seem to be coming up a lot in our daily conversations with clients. People want to know, how are people buying in this market, especially when, we're having to qualify purchasing under this new stress test, which was introduced a couple of years ago. That stress test used to be in the 5% range, and now it's in the 8% range. And so it's actually getting a lot harder for people to qualify. We're also going to look at new methods for saving for down payment that didn't exist last year. We'll talk about how people are managing these payment jumps. So if you're an existing homeowner and you are seeing your monthly cash flow slowly erode because payments on everything are increasing, we'll share with you what people are doing to manage that. And if you're about to come up for a renewal and you're going to jump from a 2% to a 6% rate, again, we'll show you how people are managing that. And this big question that we're getting often from parents and first-time home buyers is it still worth buying? Is it still worth trying to buy in this market? And we're going to be showing you some reasons as to why the idea of giving up buying and giving up home ownership may not be the right choice for you. Okay, so one thing I want to make very clear early on here is that, I've worked in the world of wealth and wealth creation. I used to be a financial planner. And now for the last 20 years, I've been working in real estate, helping people create wealth. What we've noticed is over time, it's always the asset holders who end up, I guess, wealthier than those people who have just simply saved. And if we know we need to invest and we know we need to hold an asset, the question is then, what asset do we need to hold? I'll give you some reasons tonight why you should be considering real estate, be it for your principal residence or even beyond that. And many times people leave our seminars or consultations with us, feeling that, if they had only had this information years ago, then they'd be millionaires today. So hopefully we can give you that information that will help you realize that you still have the ability to take those steps, even in this current market. And the one thing I want all of you to consider while I'm talking to you today is this: are you doing the best with what you have? You have two things when it comes to investment. We have money, but we also have time. And 10 or 20 years invested in the wrong asset class could be the difference between $200,000 or $2 million in retirement. And so, again, when you're looking at these things, it's your money, it's your time. Consider that deeply. Now, a little bit of background on myself and my team. So you've met myself and Brenda, but we're supported by a big team of people, underwriters, admin, office support, who make sure that all of our clients get top level of service. Now, up until just a couple of months ago, I'd been running my business under my name, which was Mortgages by Dion, but we recently rebranded to kangamortgage.ca. And the reason for that is I wanted to kind of link who I am to the business, but also make it more than just me. And I'll tell you a little bit about my history, which will make sense in a second here. So I was born in the South Pacific in a group of tropical islands called Fiji. Everybody knows Fiji water, but not many people know where Fiji is, so it's there. But when I was around 5 years old, my family, we all moved to Australia. So I'm Australian, and most of my life I spent in Australia. And in 2008, I made the move to Canada. And I see one of our listeners speaks Fijian, so well done, Martin. And so in 2008, in the midst of the global financial crisis, perfect timing, I moved to Canada. And in the last 15 or so years, I'm proud to say that we built a very strong mortgage business, and we've been ranked in the top 75 brokers for the last 5 years in a row. And that's simply because we've made our focus helping Canadians make significant wealth in real estate, and our clients have literally made millions along the way. I mentioned earlier that, I do a lot of public speaking, and I do a lot of education, not just to the public, but also to professionals. So that's a room full of real estate agents there. I'm a trainer at the Toronto Real Estate Board. I've also spoken on business and business growth at Harvard University. And I really do enjoy the education component of this business. And by leading with education, leading with that type of value, I'm happy to say we've literally helped thousands of people. We've got hundreds of 5-star Google reviews. We've been the winner of the Consumer Choice Award, and also we practice what we preach. So this is a property that my wife and I still own today, and here are a couple of others. This picture just looks like I own a tree, but behind that tree is another property. Here's another tree that I own with a property behind it, and this one happens to be back in Australia. And a lot of our clients have been kind enough to leave us some video testimonials, which you can check out on our website after this if you wish. Why do people choose to work with us? Here's the facts. All we do is mortgages, and we review the market for the best options for you, and our service is free. A lot of people assume that when you work with a broker, there will be a fee, and that is only the case if your situation is outside of the box, where you have less than perfect income or less than perfect credit, which is not often the case. And it's also interesting to note that our clients include bank managers, financial planners, other mortgage brokers, and many, many real estate agents. So people in this profession choose to turn to us because when it comes to real estate financing, especially growth in real estate, that is acquisition to build a portfolio, that is what we specialize in. So that's who we are. Now, let's jump into this presentation by starting with market history and where it's brought us today. So the big drivers in the market here are inflation and interest rates. I mean, that they have been the key driver, especially over the last, 18 months. In fact, for the 15 years prior to that, they were also the key driver, which saw property prices get to where they got to in the year 2022. But in addition to that, we've got housing, supply, and demand. So these are the big drivers that we're going to discuss today. And if you're looking to get into real estate, I guess it's 2 points here, but there are 4 points on the board here. Interest rates, inflation, housing supply, and housing demand. These are the key factors that you want to always keep an eye on. Now, what has happened in this last 25 plus years in Canadian history is we've had this meteoric rise in real estate values. And it hasn't come without some blips along the way. If we look here in 2008, that's the global financial crisis. 2016-17, when we had some change-ups in terms of foreign buyer restrictions and the introduction of the stress test. And then more recently, COVID, the run-up during and post-COVID, and then the drop since the interest rate ratchet has been turned up. And so here's what happened in 2020 to 2021. we went through this period of quantitative easing, okay? Now, I want you to remember this number. This number is probably a conservative number, but at least 40% of all the dollars that exist in our economy today were printed into existence since the start of COVID. And that happened really to fund CERB and CEBA and those government assistance programs. And we weren't the only country in the world that did this. Most Western countries, Australia, America, New Zealand, others also supported their economies this way by effectively flooding the economy with money so that people wouldn't default on their payments so they could keep the roof over their heads and meet their payments. Now, because of that, though, 40% of all the dollars that exist were printed just recently. I really want you to remember that number because you're going to see that number again, and I'm going to make a link to that. So why did we all go crazy in real estate during this time? Well, a lot of it had to do with this statement that came from the Bank of Canada in July 2020. This is it verbatim. It says, if you've got Tiff Macklem, the governor of the Bank of Canada, says this: if you've got a mortgage, or if you're considering making a major purchase, or you're a business and you're considering making an investment, you can be confident rates will be low for a long time. So a lot of us heard this and we said to ourselves, well, if the Bank of Canada is telling us that interest rates are going to be sub 2% for a very long time, then maybe we should listen to that and then participate in the market, because if we don't participate, we may be left behind. And so what happened to house prices during that time? Well, basically across the board, house prices increased 30, 28, 26, anywhere from 17 to 30%, depending on what type of asset class you purchased. And that was just at the end of 2021. So within a year of that announcement, year and a half of that announcement, house prices had increased by 30%. And then at the start of 2022, around March, which is about, less than 2 years after his statement, interest rates are going to be held for very low for a very long time, we turned a corner very, very quickly. And we start hearing comments that, the economy needs higher rates. So this is how I visualize what happened here. If you take a look at this is a hairpin turn. And if you're driving and you're, let me just grab my pointer here 1 second. If you are driving down this road and up ahead here, there's a hairpin turn, you would usually start to tap the brakes around here, right? You would tap the brakes around here so that by the time we got here, you would likely be in a safe position, okay? I feel like what the Bank of Canada did here was they didn't even see the curve coming, and they were in the middle of it, and they said, oh my gosh, we have to do something. And so, like in many cases, the government realized their overcorrection too late. And so while they just needed to hit the brakes, they didn't tap the brakes. What they did was they slammed their foot down. And their focus as a government and as a bank that's usually has their focus on employment and growth, their focus totally switched to just purely and simply the control of inflation. And this is what led to this significant quantitative tightening. The goal of these interest rate increases has been to really reduce the free cash flow in Canadian households by making monthly payments higher. They're basically trying to rob Canadian households of cash. Why? Because then this takes away from discretionary spending, which then makes Canadians second guess purchasing decisions. And when that happens, the overall consumer sentiment turns from negative. That is, consumers start to believe that tomorrow will be worse than today. If they do that, then people are going to change their consumer behavior. And I think, personally, I've seen enough to feel that they've done their job, okay? We've seen significant sales and price drop since 2022. And let's take a look at that journey in terms of price growth. So this is directly from the Toronto Real Estate Board, and I know there's a whole bunch of graphs on here, but I'm gonna break this down over the next couple of slides. And right now I'm just gonna focus on the, let's see here. That green line is the year 2020, and that orange line was last year, 2022. And that February 2022 was the absolute peak of the Toronto real estate market. And what happened in that 2-year period is when all this money started flooding in to the economy, we had surprisingly a 40% jump in real estate prices. Now, I'm going to mention this because this is on the previous slide. 40% jump. Anybody remember the amount of money that was created and printed into existence since 2020? Right, Sarah? It was 40%. This is not a coincidence, right? People are saying, how did house prices increase by 40%? Well, that much more money came into the economy. And the flip side of that is some people say another way to look at this is the value of your $1 devalued by 40%, which then ultimately push prices up. So there's two ways to look at it. But whatever way you want to look at it, house prices went up, or our prices got devalued, or our dollar got devalued. Now, what happened from March onwards last year is this interest rate increased step by step by step, in some cases by 0.25%, 0.5%, and even once there was a full 1% jump. And again, the goal here was to slow down the economy. And if real estate is an indication of this, then we can see what happened in the year 2022. I want to point out that interest rates, mortgage interest rates, are one of the things that we as consumers are extremely sensitive to, extremely sensitive. The other thing that we're about as sensitive to is the price of gas, right? This is why people will drive 20 kilometers across town to save 5 cents on gas. Interest rates seem to have the same kind of gut reaction and sensitivity. Now, the question here I always had was when we were watching this decline and in almost the entire pullback of that 40% increase over the course of 11, 12 months last year, I was asking myself, wow, is it that interest rates control this? Or is it that maybe, people just aren't interested in buying in real estate anymore? And I actually got the answer to that. We all got the answer to that at the start of 2023, because here's what happened at the start of 2023. We actually had several months in a row where the Bank of Canada simply did not increase interest rates. They didn't drop interest rates. They simply put a pause on interest rate increases. And as you can all see here, what happened in the first half, nearly the first half of this year, is we had a price regain. So if you're asking yourself, is it interest rates that are driving this market right now? I truly do believe that is the case. And we will look at supply and demand after this, but I just want to point out that if a simple pause for just a couple of months resulted in that type of price recovery, then ask yourself, what will happen if and when interest rates eventually drop, okay? Or we just get another period where there's a couple of months. And so, the headlines at this time, just a couple of months ago in April, sales were jumped by 27%. There's a surging, market roars back with sales and prices surging. This all happened just a couple of months ago. Then, of course, we get back to sort of almost the same prices that we were at last year in May. And then we get an inflation print, which basically tells the Bank of Canada that, you know what, they want to put their foot back on the brakes, and they started increasing interest rates yet again. And so we've seen this decline from May down to August. This gray line here, these gray bars are 2023, and we see that drop there. So that's brought us to where we are now, September 2023. Here's where we're at. Inflation is down. We were up over 8% last year. We're now at 4%. But this 4% number is higher than economists expected. So because of that, there is speculation that in October, the Bank of Canada meeting may result in yet another increase. This month, we did have an increase. I want to point out that was 0.25%. What does that mean for every $100,000 that you borrow? It means that on $100,000, your payment's up $15 per month. If you borrow, say, $500,000, then your monthly payment on that is up 0.75. Now, here, again, they've tapped the brakes. They haven't had a 1% increase. I don't believe we're going to see, if we see more interest rate increases, I don't believe we're going to see another 1% interest rate increase. I feel like there's enough cracks happening in the economy right now for the Bank of Canada to keep their increases at, I guess, that minimum 0.25. I don't think anything warrants that. And as these interest rates increase, if you are looking to purchase, I would suggest to you that you should be watching this market almost week by week, because there are opportunities that are coming where people are reaching their breaking point, and more property will be coming to market over this next 6 to 12 months. Okay. Is the economy slowing? That's really what the Bank of Canada is looking for, right? And inflation is one way to measure that, but the other ways to measure that are job losses. And I think we've all seen we've lost well over 100,000 jobs net this year. Construction has stopped because a lot of these builders have basically said at these interest rates, these numbers don't work, and they've canceled projects. And a lot of people don't know this, but 1 in 5 jobs in Canada are linked to construction. Okay, so if that's the case, then you've got to know that with all these jobs, these construction jobs stopped, then we're just seeing the tip of the iceberg in terms of job loss, which then in turn leads to potential contraction in the economy and recession. And we've seen this here. So with interest rates going from 2 to 6%, payments in a regular household on a regular mortgage have jumped anywhere from $500 to $1,500 a month. I know many of you listening to me right now have witnessed that firsthand. What that means for you is you have less cash in your household. And then, surprise, surprise, in Q2 this year, we had our first economic contraction. We did not grow in the second quarter of this year. We had a decline in growth, a contraction of 0.2%, the first time since these interest rates started to increase. And this is one of the biggest things that the Bank of Canada has been looking for to see, okay, are their interest rate increases having an impact? And I just want to remind you, the definition of a recession is 2 consecutive quarters of GDP contraction. So my gut tells me that if at the end of this quarter, which is measured at the end of, at the end of this month, September, and just keep this in mind, we won't get the Q3 reading until sometime deep into October. Then if we do have another contraction in this quarter, then the need for an increase in interest rates becomes less. And therefore, it's kind of weird to say this, but on one side, some people are cheering for a recession because that might give the Bank of Canada the direction they need to say, you know what, let us just chill. Let us not go for one more interest rate increase. Let us just let things be. Maybe enough damage has been done. And it's always the case that decisions made and interest rates changed a year or 18 months ago only filter through to the economy 12 to 18 months later. So we're seeing the tip of the iceberg right now. Here's another indication from the tip of the iceberg. Equifax, which is one of the largest credit reporting agencies that most banks turn to in Canada, this is what they saw. They saw in Q2 that delinquencies were up 26% on non-mortgage debt. So meaning credit cards and personal loans, people are actually now missing payments or they're late on payments. Also, there's been a jump in consumer proposals. This is a big jump, 42%. Okay, so a consumer proposal, guys, for those of you who don't know, it's the step between default on your payments and bankruptcy. There's a thing in the middle called consumer proposal, where basically you can go to your creditors and say, hey, listen, I'm struggling. Could we restructure our debt and pay you back over a longer period of time? And so more people are going into these consumer proposals. So that all happened in Q2. Now, something else on the other side happened in Q2, which was very sort of contradictory to the things you just see there. First-time home buyer purchases jumped by 59% in Q2. And again, I just want to put this in context, guys. That was during that same window of time where the Bank of Canada paused interest rates. So the difference between the people who are having trouble here and these people are that these people are going in to home purchases with their eyes wide open to the fact that they're taking an interest rate that starts at a 5 or a 6% rate. The people over here probably got their mortgages, if they do have mortgages, they got their mortgages quite a while ago, and they were expecting to pay, say, $2,000 a month. And now, because of these interest rate increases, they're now paying $3,000 a month, and they simply were not prepared for that increase in payment. And so it seems that the people who are buying now, and this huge jump of 59% in Q2, means that they're going in with their eyes wide open. And let's just take a quick look at where we are in terms of GTA numbers of sales, the benchmark house price. I want you to notice it hasn't dropped significantly over this time last year. But this is where things have changed dramatically. And as buyers, this is what you want to look at. The number of new listings that are coming to market this year are 16% greater than those that came last year. So there's more inventory to choose from. And active listings are up 16% as well, meaning that in addition to new listings, there are listings that were listed a while ago that still have not sold. And again, what this means is the longer that properties are on the market, the greater the choice there will be for buyers, right? And potential for price negotiation. Okay, so this is where we are at right now. So now let's take a look at the future and what may come. Now, let me make a few key points that I made earlier, but let me reiterate. Interest rates will remain the key driver in the economy. And what is going to determine interest rates? It's going to be economic growth. It's going to be unemployment. It's going to be the potential contraction in the market, as well as inflation. Now, behind that, housing supply and demand will always play a big factor. And, you know, many people are of the belief that, look, if there's little supply and a lot of demand, then prices will go up. That makes sense. That's economics 101. But overlaying that is this idea. Imagine that there was little supply and a lot of demand, like a lot of people wanted houses. But let's just say, let me give you a ridiculous example. Let's say all the houses were $4 million. If that was the case, would those sales transact? The answer is no. Okay. So while housing supply and demand, and we all probably know this, and I'll show you some numbers here, demand greatly outstrips supply. It is the affordability factor. The affordability factor. What is that monthly payment? Is it a monthly payment that we can afford? And that is driven by interest rates as well as pricing. And so right now, pricing is a little bit too high for some of these people, and the affordability factor is not there. But again, you saw this earlier. The minute that that interest rates start to flatline and or drop, affordability becomes reintroduced, confidence returns, and people will be buying. So let's just take a look at this demand side of things for a second. I think you all know this by now. It's been in every media outlet for months and months. You know, Canada's population grew 1 million in 2022. And I want to point this out. That's the population. That's the countable population of Canadians and permanent residents. This does not include international students. This number does not include people on workers' permit. That and many, many international students then graduate into a workers' permit. So a lot of those other people who live in Canada are counted in this population number, okay? And do you think that we're slowing immigration? No, we're not. By 2025, the target is to bring in nearly another 1.5 million permanent residents. This year, we are on track for a new record. We're on track for 1.2 million growth this year, again, Canadians. And let me show you what happened during COVID. So the blue line is population growth. The red line is growth of housing completions, okay, housing completion. And what you've noticed here, what you can notice is there has always been a gap. This goes back to 1980, okay? The gap was closest back then. And as we've progressed, that gap has slowly grown. We made some inroads here in 2015, but since then, we've had explosion of population growth, but no growth or no increase in housing supply. Now, what happened here? What do you think happened here? This was COVID. Airports shut. So immigration stopped. But guess what? Effectively, the next year we doubled down. And so whatever was the reduction was made up for the following year. Okay. And, another couple of things to note here. We need to Ontario is to double the number of skilled immigrants by 2025. And Canada needs 300,000 new rental units to avoid that gap that I just showed you quadrupling by 2026. Now, we might have seen recently some government programs where they've dropped the HST on apartment building construction, rental building instructions. They've also got a government fund to start funding some of this, but it seems like they're starting a little too late. While those programs are there, we're probably talking about 5+ years before those products come to market. So we've still got quite a bit of a hurdle to get through here. And something else sort of in the news quite a lot lately is this drama that's happening between Canada and India. And I bring this up because a lot of my clients do own properties where they do rent to international students. And there's some speculation that the government of India may be deciding very soon to redirect their students to different nations. Let me just show you this really interesting chart. Where do international students in Canada come from? Okay, you can see that India is the leader by far. 40% of our international students come from India. And that represents over 400,000 of the 800,000 plus students that come to our country every year. And guess where most of them come? Most of them come to Ontario. More than 51%, over 400,000, come to Ontario. So something to watch. Just keep in mind, these numbers that I'm giving you here are not counted in that 1.2 million increase that we mentioned earlier. And it's anecdotal at this point. I don't think this is enough to move the needle in any way in terms of our need for housing supply, whatever might happen with our relationship with India. But yes, just sort of something that's in the news that I wanted to comment on. Okay, and then yes, in September 23, this is what you should all be watching for: inflation numbers, unemployment numbers, and GDP growth. What happens between now and October 25th, which is when our next Bank of Canada decision is, or what happens in these areas is what's going to determine what happens on the 25th. Will we get another increase in interest rates? Now, in terms of the future of real estate, just a couple of years ago, 2016, Toronto Life made a prediction for the future of Toronto real estate. And back then in 2016, I read this and I kind of scratched my head and I said, could this be real? In 2016, they said that by 2066, 50 years from that date, the average house will cost $4.4 million in the GTA. And I couldn't believe that. But I think all of us listening now, having seen the meteoric rise of pricing, understanding that when interest rates somewhat stabilize and the supply and demand scenario comes back into the picture, I don't think this $4.4 million number is ridiculous. And it's likely that we'll probably hit it before the year 2066. And, then I always visualize, what's happening, what is going to happen in Toronto, in the GTA, is not dissimilar to what has happened in the United States, in the city of New York. Question is, who owns property in a place like New York City? And obviously, it's people with intergenerational wealth. And frankly, guys, we are going that way, meaning that if you think as a parent that your job is done once you get your child an education, I am sorry to say that in the world into which we are stepping in terms of real estate, I truly do not believe that that's going to be enough, and you're going to need to help them. We'll talk about this in a couple of future slides here. So the future of real estate may be people with property trading property, okay? It feels like we're going back to medieval England, where we have our tenants and our landlords. But guess what? You don't have to agree with what is happening, but you're going to have to decide which side of that fence you want to be on and which side of that fence you want your family to be on, okay? There are going to be fewer entrants into real estate ownership from the traditional get a good job, get a good income, be able to buy a property. Okay, I'm seeing it every day. Okay, the fact is that that is not going to be enough. It is not enough now. And, you know, we know it's hard now, but the question is, will it get easier? And again, I'm not a doomsdayer. I'm a glass half full kind of guy, but I don't believe that it's going to get easier, at least for the next decade or so, based on the supply and demand issue. So as I said, once this interest rate thing gets kinked out, and that's likely going to happen over the next 12 to 18 months, once we reach a sort of a new normal, then I think it's only going to get harder in terms of qualifying. So listen to our famous Gretzky here. Skate to where the puck is going to be, not where it has been. And where what this means is the way that your grandparents and your parents bought property will likely be very different from the way that you can buy property. Okay, so let me talk right now to the first-time home buyers who are listening, or the parents or grandparents of those first-time home buyers. After we talk to you guys, I also want to talk to homeowners. We've got a section for you, and then we've got a section for investors. So first, let's talk to the first-time home buyers listening today. How are first-time home buyers qualifying? Well, let me tell you, we see this every day. They are almost never doing it by themselves, okay? In today's GTA is unfortunately not made for a single income earner. We must have two strong income earners, so maybe a young couple earning well over 100 or maybe over $200,000 a year, or they're approaching it very differently. Here are a couple of options that we're seeing our clients execute daily. So house hacking, okay? Getting some income while living in the property. So probably everybody's watched HGTV and seen them finish the basement or whatever the case may be. The reality is many of our clients have been doing that for many, many years. They're buying properties where they rent out the basement. Some of our younger go-getter type clients are living in the basement and renting out the upstairs because they know that the upstairs is going to bring in more, and they don't necessarily need all the space that the upper unit brings. Another way that people are approaching their first acquisition in real estate is they're actually deciding to make that first purchase an investment property, meaning that they are living with their parents or they're renting a property elsewhere because maybe they work downtown and therefore they need to live downtown. But what they're doing is they're buying a piece of real estate where it makes sense for them from a rental perspective. And that may not be where they live. It may be an hour or 2 hours outside of the core of the GTA, but that's where people are seeing numbers still work in terms of investment property. And this is a really interesting stat here. 15% of property investors in Canada do not own their principal residence. And I can tell you, I've helped a bunch of these people who, again, are living at home with their parents or they're renting, and they're like, you know what? I still need to get my foot on the property ladder. So the first purchase they make is in fact an investment purchase. That was actually my scenario too. The very first purchase I made back in Australia was in a property about 45 minutes away from the city I lived because the numbers worked. And that was the property that built equity, which allowed me to go off and buy more and more. And guys, this is another big point here. Family help. And there's two ways that family can help. One is by co-signing. and the other is by gifting down payment, or you can do a combination of both. And again, we're seeing this every day. So just to be clear, the stats are that at least 30% of first-time home buyers are having family members co-sign on their mortgage so that they can qualify at today's stress test. Okay? So if you're a child in their 20s or 30s or even 40s, and you may be beating yourself up about the idea that, oh, geez, I really don't think I should ask my parents to help because, they've done enough. I'm here to tell you that your parents are actually probably in a position to help, and it's not unusual. It is happening every day. And if you're a parent considering whether this is something that you should consider doing, you don't want to be just throwing all your money at your kids for your life, but truthfully, 30% of all first-time home buyers are getting co-signing and or a gift for down payment. Okay. Now, another thing that people are doing is partnering. So rather than just getting a pure gift, we're seeing siblings, brothers and sisters who each qualify for $400,000 and realizing that $400,000 by themselves buys them nothing. They're combining and they're buying for $800,000, realizing that at least together they're owning something, they're building equity, and they have the potential for future growth. We're seeing a lot more of this right now. And then this one here is actually happening more and more. And we've always known that a big cohort of the immigrant population in Canada generally stays in their home and lives in that home longer, maybe well into their 20s, 30s, et cetera, et cetera. But we're now seeing this idea sort of break through to the larger population where, I've got clients who have 20-year-olds and 30-year-olds living with them in their basement and realizing, you know what, the way that things are going, they're likely going to be there for a while. And therefore, let us buy a larger home together with them, leveraging, maybe their child who lives with them makes an $80,000 or $100,000 income, and they're buying a larger home. So I recently had a realtor actually contact me with the intention to sell their family home at $1.4 million and actually go and buy a triplex at a little bit more of an expensive price at around closer to $2 million. But each of the 3 units would accommodate the older couple plus one daughter and one son. So they could each have their own unit. So these are the types of approaches that people are taking in today's economy. Now, what I want to say to everybody listening is a lot of the older people in families here, we're talking parents in their 50s, grandparents in their 70s plus, they look at the market, they look at their younger family members who are trying to buy in this market, and they say, you know what, we managed to make it work. It was hard for us as well. And they should be able to make it work for themselves as well. They should be able to do the same. But I really need to point out a couple of things, okay? Number one, prices, while they are down from the peak of 2022, they are still 3 times higher than they were just 10 years ago. Anybody who's listening to me, who owns a house, who's been living in their house for more than 10 years knows that you bought your house for $500,000 and today it's worth $1.5 million, okay? Last year it was worth 1.7, 1.8. This year it's worth 1.5, okay? Now, wages have not increased by 3 times in that same time frame. We all know that. They've increased, but nowhere near that amount. And interest rates are over 2 times higher than the average over the last 10 years. In addition to that, we have this stress test, which makes you have to qualify at around 25% above the actual rate. So if you're getting a 6% rate, then we're looking at you trying to qualify at 8%. And the ability to qualify is simply getting harder, right? So real estate used to be just about shelter for families for the longest time, but especially over the last decade, it is now an investment asset where people create and hold wealth, meaning that these younger people in their 20s and 30s who are trying to enter the market aren't just competing against other 20 and 30-year-olds. They're competing against 50 and 60-year-olds who have been disappointed with their returns in the stock market, who are now investing in real estate and are able to pay a little bit more and qualify, because when you're 50, guess what? You're likely earning at the top of your income bracket. When you're 25, you're not. So for all of these reasons, guys, it is exponentially harder to buy real estate today than it was 10 years ago, 30 years ago when your parents bought, 60 years ago when your grandparents bought. It's a different world, okay? It is harder. That's why it feels harder. And you might be saying, you know what? Okay, I'm just going to give up. That's it. I'm not going to buy real estate. I'm just going to do what the financial gurus say. I'm going to go rent and I'm going to invest the difference in the stock market. I say, if that's your plan, that's fine. The problem with that is many people forget to do the second half of that. They forget to go and invest in the stock market or do something that's going to make something with their money for their retirement. And this is a very important report that came out from TD last year. Homeowners are 700% wealthier than renters. This is pure fact. So they interviewed people between the age of 55 and 65, so that's the 10 years up to retirement age. Homeowners had a net worth of $1.4 million. Renters had a net worth of just $200,000. So literally 7 times less. Okay. And what I want to say to those older people listening is I want to ask you this question. If you won the lottery, would you share some of your winnings with your family? I think every time I ask this to somebody, they always say, of course I would. Of course I would. Actually, let me ask you in the chat, guys. If you won $1 million, what percentage of that would you consider sharing with your family? Type it in. None. Love it. I love your honesty, Naomi. Very, very honest. Anybody else? 10%? Okay, I bet that's pretty good. Someone from the Galaxy A12, depending on the need. Okay, I like it. None from somebody else. Joseph says 20. That's generous. That's it. Okay, I'm just going to assume that everybody else is going to say some. Oh, 59. 59%. What an interesting number. 50 to 60%. I know $1 million is not a lot. That's a fair comment. $1 million today is not what it used to be. Okay, so for those of you considering this question, what I want to say to you is if you happen to be a homeowner and you've owned a house within the last 10 years, well, guess what? You basically won the lottery, okay? I'd love to think that it was because, we were all super smart, but it's really we were at the right place at the right time when the government had their money printer on and inflation happened. And as money supply increased, guess what? Your house value went up. So you are the beneficiary. Congratulations, but your kids and grandkids are the innocent victims, right? So they are literally going to need your help. Now, for parents and grandparents, I know deep down you probably want to help, but you should also have some reservations because you have to live your life and you're going to live a long life based on, the medical capabilities of our health system today. So while you want to help, you have this fear and a rightful fear of robbing from your future self, your retirement nest egg, right? So you don't want to create a future problem where you become a financial burden on your family. And the good news is there are ways that you can manage it all. There's a couple of ways. So one way, before I get into that, let me just point out a really interesting fact. Okay. So how many homeowners in Canada have a mortgage? Now, again, into the chat here, this is just for fun and there's no real reason to be embarrassed about a off the number. Sorry, I guess that's way off the number. But I want you to imagine here 100 owned houses. Okay, so there's 100 houses. They're all owned. Okay, what percentage of home owners have a mortgage? Take a guess. So Steve says 75%, Cindy 60, 79. So what percentage of 100 owned houses have a mortgage? 80%? 40%, 25%. Okay. All right, 85%. I think the vast majority are saying more than 50% of houses have a mortgage. Okay, so let me surprise you. So on a street where let's say every house is owned, 67 houses, that's 67%, have no mortgage. Zero mortgage. Only 33 houses, 33% of properties in Canada have a mortgage. I know this number is surprising. Okay. And so if you're in your 20s and 30s and saying to yourself, you know what, I don't really know if my parents or grandparents can help me, let me tell you, they most probably can. In fact, there's a 67% chance they probably can, right? And even if they're not totally mortgage free, they're probably very close to it. Okay, here's a couple of ways that we are seeing families work together to help people into home ownership. Okay, so here's a real life example of a conversation I had recently. We've got a grandmother, she's age 70, she's totally mortgage free. Okay, her daughter and the daughter's husband, they're in their 40s, they have kids, and until now they've been renting. They have been tenants. But now the daughter's gone back to work and the husband's working, and they can now buy because they've got a double income. But due to down payment and affordability, they would need to purchase hours away from where this grandmother lives, right? Meaning that the grandparents would never see the grandkids. Okay, so this is literally happening. And you know, this idea of drive until you can afford to buy, it's been going on for a very long time. So in this scenario, we've been talking with this family where grandma can access $300,000 equity from her home. She's going to gift that to her daughter. And because of that big chunk of down payment, the daughter and her family can buy a property that's closer to grandma. Okay, so what happens here with a reverse mortgage, and a lot of people don't know this, there is no income qualifying. So a lot of people say, oh, my grandparents are on a pension, there's no way they would qualify for a mortgage. Well, with a reverse mortgage, there is no income qualifying, and there is no repayment needed for grandma to pay on a monthly basis. Now, these loans do not lend more than 55% of the value of grandma's house. And that's how they can actually ensure that there's enough equity in the home to make that payment. I won't go into the nuts and bolts of reverse mortgages here, but I just want to point out that if you're thinking of helping your grandkids, or you are a child and you are wondering if your parents or grandparents can help you, but you don't want it to be a burden on them monthly financially, then this is a way it can be done. And like I said, 67% of households in Canada do not have a mortgage. And this is truly a win-win. In this scenario, it's a win-win because, number one, the daughter can get to live in a location that serves her and her life and her children, but also they get to be close to grandma. So grandma wins, so she's going to actually live out her days being able to visit with her family, which I don't know how you put a price on that in today's world where I guess people are getting more and more isolated. And this is really important. We talked about this earlier. Canadians now expect to need $1.7 million in order to retire. So grandma here, we also need to make sure that in addition to her being able to help her grandkids, that maybe we also help her create some wealth for her retirement. I'm going to come back to that in a later section where we talk about investing. For the next little bit, I want to talk to homeowners who are potentially worried about renewals. Okay. So actually, I'm just going to ask Brenda if you're there, if you could just drop in the chat there. If you're a first-time home buyer and you want to talk about purchasing, talking to your family about how to have these conversations, we actually have these conference calls with everybody on the call where we can work out with the parents and grandparents, okay, how do we all work together so this is a win-win? So if you're interested in a call like that, feel free to book in the booking link there. Now, homeowners, okay? We're talking to a lot of homeowners who are worried about payment shock, okay? Renewals coming up, payments jumping. And so here's what's happening. Many people are exiting rates at 2%, and at renewal, the new rate that they're getting is somewhere in the 6% range. And as mentioned earlier, this means that a lot of people's monthly payments are jumping by $1,000 or more, okay? So what can people do to manage this? So one easy and simple thing here is to stretch out your amortization. So maybe when you originally got your mortgage, you got a 25-year, you've renewed a couple of times, so now you've got 15 years left on your mortgage. That's great. But if that means that your monthly payments jump by $1,000 because the interest rate's up and it's going to put stress on your family, then one thing to consider is stretching out your amortization. Now, I can already hear people screaming, well, hang on, Dion, that means we're going to be in debt to the bank for a longer period of time. The answer is yes, that does mean that. But if it means that you are able to stay in your home longer and let appreciation occur, let's say you're able to stay in your home for another 10 years because you chose to stretch your amortization, then it's, in my opinion, that being able to remain a homeowner rather than the alternative of selling and becoming a tenant or dramatically downsizing, I think stretching out your amortization should be one of the first things that you consider, okay? The other thing is you might have outside debt. The big one that we see a lot of are car loans. Let's say you're a 2-car family and there's a $1,000 car payment of $500 each. 2 cars, $500 each, so it's $1,000. We can often roll that debt into your mortgage and drop that $1,000 down to $200 or $300 because mortgages are amortized again over a longer period than, say, a 4-year car repayment. This can also be done with car leases where we help people buy those leases out. So if cash flow is an issue, please understand that we can look at that and maybe do a combination of debt roll-in and amortization extension. This is another thing that we're seeing a lot of. There are people who have decent interest rates right now. Okay, the rates are not bad. So they want to keep that interest rate, but they're still having some issues with payment of other things. So what we're doing is we're keeping that existing mortgage in place, and behind it, we're arranging a different kind of credit facility. Maybe we'll get you a home equity line of credit. Let's say we get you $100,000 cash, available cash through a home equity line of credit. What that is it's your ability to make your payments and maybe get you through a rough period of time so that you can just, again, maintain that home ownership. It's not dissimilar to the amortization strategy where, yeah, maybe you're going into more debt or debt for longer. But again, if it keeps you in your home, it allows you to manage your payments. Then while it is not ideal, it is better than the alternative, right? And what is the alternative? Well, sell and downsize. And for some people, that actually might be the way to go, right? If you've explored all other options and you know that in 6 months from now, the writing is on the wall and you are potentially going to get to the point where you're going to start missing car payments and subsequently mortgage payments, then the time to sell is not 6 months from now. It is today. And if any of you have questions around that and what to do in this tight economic time, again, we are helping a lot of people just sort of protect themselves during this tough period. Again, in the chat, Brenda has the links already there visible. If any of you are in these types of situations, we need to talk to you now, not 6 months from now, but right now, and say, okay, here are the problems we potentially see on the horizon, and we can give you options as to what to do right now. All right, and finally, now let's talk about the future. So let's say that you're not a first-time home buyer. Let's say that you're in a situation where, okay, payments are under control. Then maybe well, what I will say to you is you're in a much better position than a lot of others, okay? Maybe you're in that position where you are in that 67% of people who don't have a mortgage on your home. Congratulations. Or maybe you've just got your payments under control. You have a mortgage, but everything's fine, okay? So earlier I asked, why are you here? And a lot of people come to us to talk about the concept of debt freedom, setting up their kids' education, but also setting up their kids into property ownership, and then a retirement, adding some significant numbers to their net worth. So let me cover a little bit about how we've helped people over the years here. So this is an example of a client of ours named Jason. When he first came to us, he worked for a large company, father with young children. He owned one property, which was his family home, and he wanted to set up for an early retirement. So together we created a plan and we executed on that plan. He now owns close to $6 million in real estate wealth. And Jason, I believe, this I haven't checked in recently, but I believe he did retire in his 40s, meaning that he stepped back from the corporate job, and he's basically in the world of real estate and investing now. So that's an example of one. We've helped, like I said earlier, thousands. What is the secret behind how people make money in real estate versus in, say, different asset classes? And it really comes down to this concept of risk and how banks view risk in different asset classes. So let me give you this simple example where most people who have, I want you to imagine that tonight I drop $100,000 on your doorstep, and tomorrow you get to decide what to invest in. What most Canadians invest in are mutual funds. They'll do it directly through their financial advisors, or they'll do it indirectly through RRSP contributions and other things like that. But I want you to imagine that you go to your bank tomorrow to explore buying mutual funds or buying property. Okay? Now, the question I have for you is, when you drop that $100,000 on your bank manager's desk tomorrow, and I'm going to ask this question in the chat, when you drop $100,000 down and you say to your bank manager, hey, I'm going to invest my money with your number one financial planner, and you ask, how much will your bank loan to me to invest with your financial planner? I'm going to give $100,000. How much will your bank lend me and match me with? Anybody want to take a guess? Take a guess as to how much your bank will be happy to loan to you to invest in mutual funds. Yes, right. Those who have answered correctly. Usually people answer it slightly higher. Maybe you already know this. Maybe you've tried this. Okay. So yeah, the answer is 0. Okay. So if you've got $100,000, great. That's all you're going to invest if you invest in mutual funds, because the bank will not loan you money to invest in mutual funds. Okay. And you'll have $100,000 invested, and that's fine. Okay. Now, when we go to property, so tomorrow, same day, same bank manager. But the question now is, I'd like to buy a property. As long as I qualify, how much of a mortgage will you give me? If I got $100,000 as my down payment and I want to buy an investment property, anybody want to guess how much will they lend you? Correct. 4 times. Yep. So they'll lend you 80%. So here, they'll lend you $400,000, meaning you can go off and buy a $500,000 asset. So if your goal was to make $100,000 over a 5-year period, then with that mutual fund, you would need to make $100,000 with your $100,000 invested. You would need a 100% return, which is like getting a 20% per year return. Nobody I know has got that in mutual funds. Okay. But to make $100,000 with your $500,000 piece of real estate, well, we basically need a 20% return, because $100,000 is only 20% of 500. Okay. Over that 5-year period. And this is why so many people have started to turn to real estate when they realize that the playing field is not level. It is set up for success in real estate more so than in the other traditional means. Okay. And, getting a 20% over 5 years is great, but would anybody like to aim for a 25% return on your investment most years? Would that be a good thing? I think so. Okay, so let's say you purchase an investment property for $500,000. Okay, you invest $100,000. That's your cash down, 20% down, because the bank lends you the 80%, $400K. So to get this 25% return on investment, all we need to happen is a 5% increase in property value. Now, I know we've been on a roller coaster ride these last couple of years, but 5% is in fact lower than the 50-year GTA average. And so 5% is actually quite a conservative number. And so your $500,000 property at the end of 12 months is now worth $525 in regular years. You're up $25,000. And this is how you get a 25% return on your investment, because your down payment was only $100,000. If you put in $100,000 and your asset increased by $25,000, then you basically have a 25% return on investment. And I know many of you are saying, well, Dion, we didn't get that in the last year. I understand. This is not about a 1-year game, okay? This is a 10+ year game. And if you're not in it for 10 years, don't look at real estate. Real estate is not for you. Look at mutual funds or stock trading or something else. People also say then, well, Dion, what about the risks? You know, I'd rather put my 100 grand in mutual funds than borrow money to invest. And it's because from a very young age, we are all taught that debt is risky. What I've come to learn in my 20+ years in real estate and finance is that risk is not equal to the amount of debt that I owe. It's a function of demand for the asset that I own, control over the asset, and the exit strategies I have. You know, earlier today, guys, I asked you to compare, ask yourself, are you doing the best you can with what you have? What I want you to do when I'm reading this slide out to you is ask yourself, what kind of demand do the assets that I own, let's say you're investing in mutual funds and stock, what demand is there for that? What control do you personally have over that? And what exit strategies are available to you if you need to dump that asset and move on with your life? So an example of this in the world of stock, the stock market, an easy one is about 20 years ago, a company called Nortel. It was one of the, well, it was a blue chip stock in everybody's mind, but one day about 20 years ago, demand for that stock dropped. A lot of people, you had no control over it. And basically exit strategies, well, basically you would have lost your life savings. And I've spoken to some people whose parents were the victims of that crash. Now, in regards to real estate, well, in terms of demand, you know, I've shown you the economic numbers in terms of population growth and the fact that we're not going to catch up. Supply is not going to catch up for a very, very long time. So we happen to be in a country, and in particular in a province where we have, you know, the most demand. In terms of control, we've got, when it comes to housing, you can buy the ugly duckling. You don't have to buy the most beautiful house on the street. And there are things that you can do that are inside of your control that impact the value of that asset. And in terms of exit strategies, well, in real estate, there's a bunch. You can rent the property, you can sell it, you can improve it and rent it for a higher number or sell it for a higher number. You can change its use, maybe make it a duplex. Many of our clients do that. We can do a rent to own where we buy a property and we rent it to a tenant who will ultimately buy it from us. Or we can increase its value, appraise it at a higher value, pull out equity and do it again. So we've helped many clients with all of these strategies over the years. Now, even though the numbers make sense and you've now assessed the risk and you get your head around the debt, there's still something that stops the majority of people from investing in real estate. And it's these ideas. Don't want to be a landlord, don't want to deal with tenants. What if they don't pay? What if they damage the property? And I don't want to fix toilets in the middle of the night. Okay. Guys, let me say this. If I had to deal with these things, I also would not be a property investor. Okay. But the solution to these problems is quite simply engaging professional property management and getting the right type of insurance so that if the property is damaged by the tenant and it needs to be renovated and you lose rent for that period of time, the right type of insurance covers that type of loss. Okay. Now, a lot of you are saying, well, if I pay a property manager, then I'm going to lose some cash flow. And I'm going to say to you, yes, that is the case. But people don't get rich in real estate from the $100 a month they save on property management. Where they get rich in real estate is in the compound effect. So take a look at these numbers. Let's imagine that you bought a property for 500 grand. Let me be the first to say, I understand buying a property of 500 grand is very hard in today's world. This is just a placeholding number. We've helped people buy properties and finance properties at the $5 million mark and at the $250,000 mark just in the last year. So 500 grand is just a round number for simplicity today. But if you bought a property for 500, and let's say it grew at 5% growth, and that means that would increase in value by 25 grand in a year. meaning you end the year with an asset worth 525. Okay. I don't think that's extraordinary. I think most of us have experienced that or more in our own property ownership journey. Now, that means you start the second year at the value of 525. And if, again, we get this same growth of 5%, then the number increases and so on and so on. So at the end of 5 years, the place you paid 500 grand for is now worth 638,000. The difference between the purchase price and the new value is 138 grand. And the principal pay down in this example is 51,000. So the impact on your net worth over that period of time is about 189,000 in positive net worth. Okay. A couple of things I want to point out. This 5% a year, every single year, 5 years in a row, this is not real. This is just an average. We're going to have 5, then 0, then 10, then -7, and so on, right? But 5 is the average number. Also, this assumes neutral cash flow, meaning that the rent you get covers the expense. Now, I know that's getting harder and harder, but even if you had to throw 30 grand in negative cash flow at this property, you're still going to be 150 grand better off than throwing the 30 grand in a mutual fund, which will be worth maybe 35 grand over 5 years. So again, this is why a lot of people are turning to real estate. Okay. Now, the rental market. I want to point this out. I mean, year after year, as much as house prices have increased, the rental pricing has only ever gone in one direction. And again, this last year versus this year, we're up around 20% again. In terms of real estate ownership, guys, listen to Uncle Warren here. He's talking about the stock market, but you could relate this to real estate as well. He's like, if you are not willing to own a stock for 10 years, do not even think about owning it for 10 minutes. It's the same with real estate, in my opinion. I know there are people out there who flip and all of that, but if that's only if you have the risk tolerance for it. The majority of our clients are people who have families and therefore cannot take that type of risk. And so you need to have a 10-year horizon. Okay. And let's take a look at that property ownership. If after 5 years, the impact on your net worth is positive by, say, 189 grand, then at 10 years, that same property, if you just kept on holding it, your net worth position would be 427,000. Then the longer you hold it, the higher that number, right? And as impressive as that, $1 million and $2 million number is, I want to remind you that your down payment, your investment here was only 100 grand. Only 100 grand, because you had to just put the 20% down. And so what's more important than the 189 number is how much did your family's net worth increase every year that you owned that property? So every year for 5 years, your net worth increased by $38,000 in that example here. And as the longer you hold it, the higher that number is, right? So over here, it's $72,000 a year if you held it for 30 years. Okay, I haven't had anybody tell me that their financial planner has told them if they invest 100 grand, that 100 grand should on average make them 72 grand over every year over 30 years. Okay, so this comes back to a couple of simple plans that we have for our clients. One here being the 15-year, $2 million plan. So again, this is based on the idea that, the average annual growth is 5%. If you're an investor, then you probably already know this. But if you don't know this, there's a thing called the Rule of 72. Google it later on. But the Rule of 72 tells you how long it takes an asset to double in value based on a certain rate of growth or return. So at a 5% growth, it tells us that property prices double about every 15 years. Okay. Now, if you buy today I want you to just go with this example. We buy today for 500 grand, and let's assume we can get all of it financed because we borrowed the down payment maybe from the house you live in. Okay. And in 15 years, what will likely happen is the property that you paid $500,000 for will now be worth $1 million. and we have $300,000 in debt because the mortgage, which started at $500,000, should be paid down. What happens is we have a net worth. The difference between the asset value and the debt is $700,000. And I know that that's not $2 million, but most of our clients don't buy one. Once they get the ball rolling and they realize, okay, this thing works, then they'll go out and buy a couple. And, that's how we get our clients to that $2 million number. And I will say this only will work if the real estate market returns to some level of normal. And if there was any concern around that, then the evidence that I needed to prove to myself that, okay, when things get stabilized, things will return. The evidence I needed was this: the first half of this year, when the Bank of Canada put pause on the interest rate button, then what happened? We went back to an increase in property values. So yes, we're going to have a roller coaster, but in the long term, when things stabilize, when interest rates come back into some normal territory, and when I say normal, guys, please be clear. Let me be clear. We're not going to see a 2% interest rate. I don't think we're going to see that maybe in the next 20 years. But once things know, and these purchases all happened in an interest rate environment at 4 and 5%. And I truly do believe we need to get used to that idea. But even at that level, we can see what happened to price points in the GTA. That's probably your new future. Okay, so in terms of, paying off your debt, setting up your children, setting up your retirement, you can imagine what this type of money does for those goals over the years ahead. Okay, the simple one is, this one here, 20 years, is about the length of an RESP, the Education Savings Plan you get for your child. Invest for 20 years, your child ends up with about $100,000. Invest in real estate, all things going well, your child won't end up with $100,000. They'll end up with 11 times that number. So if you're investing for your children, maybe consider that. This is how our clients are achieving debt freedom, paying for their kids, building wealth for retirement. They're doing it by allocating part of their real estate investment portfolio to solve that problem. Okay. And again, I started off by saying, are you doing the best you can with what you have? Many people come to us trying to work that out. And, here's an example. Sally came to us, small business owner. She had this dream to buy her retirement home before retirement, like this cottage up by the lakes, right? And also, simultaneous to that, she wanted to grow and expand her real estate portfolio. And within a couple of months, she made 2 purchases. She's feeling confident about her retirement. She also helped her daughter into the property market, helped her nephew grow his portfolio, and helped her son, who's in his 20s, buy his first home. So she's one of those people who really does believe that, yes, you know what? Real estate is now a team sport, a family team sport. And she's decided to be the leader in that regard. So maybe this is of interest to you. Maybe some of the things we've talked about here are things you want to explore. And if that's the case, there's a couple of things that you must get clear on. Firstly, you need to figure out, what are your goals? There are 2 big goals when it comes to just finance in general. Cash flow, what do you need on a monthly basis? And net worth. How much asset do you need to have behind you to feel comfortable in life, right? Also, it's then about putting together the right team who's going to help you determine what to buy, where to buy, manage the property, how to run the numbers, and maybe how to partner with family or friends, or maybe even external business partners who aren't related. And also, so we're helping some of our clients actually be the bank. So lending money is another aspect of our business, where a lot of our clients who have cash and are looking for better than their 5% returns are getting returns of 10% more by being effectively private lenders. And we can help you with all of that. So as mentioned earlier, for those of you who've been kind enough to give us some of your time and get educated, then we'd be very happy to sit down and give you a free consultation to figure out where you are, where you need to be, and how we can put in place some steps to get you there. We'll give you clarity around, your financial circumstances, and then set up some goals and timelines, and then create a plan customized for you to hit those targets. And to do that, you can email us at welcome@kangamortgage.ca, or more easily, just click on the link that's been provided there in the chat by Brenda, and we can talk more on a one-on-one scenario. Oh yeah, and let me tell you who uses these types of plans. Who are our clients? We've got doctors, janitors, business owners, tradespeople, teachers, truck drivers, office workers, engineers, as well as people who work in our industry, financial planners and bankers. I, in fact, just had a conversation with a financial planner who was complaining to me about the fact that he's got a 25-year-old living in his basement, and he doesn't know how long that she's going to be there because, she can't afford to buy her own home. And so financial planners are turning to us as well. And again, maybe you now are feeling this, if you'd had this knowledge 10 years ago, taken some action then, you'd be a little wealthier today. Do not beat yourself up about that. That's okay. We've got the next decade ahead of us. So let's work together and see if we can get you on that right track. Okay, that ends the slide presentation, but we are going to do the Q&A, so give me a second here. Okay, I still see we've got a bunch of people who've hung on to the very end, and thank you for your attention in this world where everybody's scrolling on TikTok. It's quite challenging, so thank you. Okay. So Brenda, do we have any questions in the Q&A? And if anybody who's still around wants to type in a question, just type it into the Q&A and we'll hang around and answer a couple.
Okay. Yeah, we have a couple. With the possibility of another rate increase, how does that look for mortgages?
So again, like the simple math there is, okay, right now you're looking at interest rates around 6.5%, plus or minus, but let's just pick a middle number, 6.5%. Now, what that means, what another, say, 0.25% increase means is that on 100 grand borrowed, we're looking at an increase of about $15 per month. Brenda, last I checked, correct me if I'm wrong, but I think to borrow every 100 grand today is at around $600 a month. So this would take us to around $615, $620 a month. Okay. For a lot of people, it's good to ask this question because you want to know not just what the rate is now, but what will it be if you take a variable, and you've got to run your budget. Like, just because you can qualify doesn't mean you should buy. I'll be clear there. There may be some of you listening today who, it might be a stretch to buy. So maybe it's something that you should reconsider. I should have mentioned earlier when I was talking about people getting help from family, not only are they getting help with qualifying for the mortgage, but around 25% of first-time home buyers are getting help with their monthly payment from their parents as well. Again, these are things that we really do need to consider. Okay. Next question there.
Have you followed this strategy yourself? And if you have, why are you still working so hard?
Oh, okay. Yeah. So, that's a great question. So years ago, I was part of a mastermind group. Nobody's ever asked me this question, so I'm going to have some fun with this. I was part of a mastermind group where they said, Dion, what would you do if you hit all your financial goals? And I said, I would just go and sit on a beach and drink pina coladas for the rest of my life. That was my answer. And then they said, okay, sure. How long doing that until you get bored? And, when you really ask yourself that question, I said, it's probably a month or two. And I said, okay, so let's say you did that. What would you then do after that 2-month period? And I said, well, you know what? I would actually like to then take the knowledge that I have and teach other people how to do it. So the real answer to your question is yes, I'm happy to say that I am financially independent. We do travel a lot. In the last year, we've traveled to Australia, Fiji, and the Caribbean multiple times. And so, we live that life. But also, I would be ultimately bored if all I did was just sit on the beach and drink pina coladas. So hopefully that answers that question.
All right. In the example you gave where the grandma did a reverse mortgage for $300,000, what is the strategy for her retirement and the money that she will need?
Yeah. Okay. Great question. So in terms of that, number one, it's not that $300,000 is going to be looked at as what we call effectively a living inheritance, right? So in scenarios like this, let me ask everybody listening. Would you rather receive $300,000 at age 40 or $800,000 at age 60? Okay, $800,000 is double the number, but if you got it earlier in life, then you're likely going to go buy a property and you're going to earn a lot more than the 800 grand. You're going to end up with assets worth 2 million plus. I've run these numbers a couple of times. Then in terms of the grandma in that scenario, she may not need to give that entire 300,000 to her daughter. There is actually going to be a little bit surplus there, and we are going to have a conversation with all of them about not just helping the daughter, but also being potentially a part owner in that asset and buying investment property for her grandkids. So $300,000 will be the gift, but as I said earlier, we can actually access up to 55% of the value of the asset, meaning if you've got an asset worth $1 million, then we can access $550,000. And so in her scenario, she has a little bit more room. And then this ties in with another question I see here from Paul, which is, do we find rental properties? So we don't ourselves find investment properties. We direct you to the realtor who likely sent you here. If you're not attached to a realtor, you found us online or some other way, we would introduce you to a realtor that we know specializes in investment property, owns investment property themselves, and will be able to find assets that in the long term will likely perform for you. And that's a combination of cash flow and location, which means good growth. So these are the things that we can assist you with, not be it indirectly, but yes, investment. So if this person here, and her situation is such that she's not just a pensioner, she does have a pension, not just a government pension, she has a pension from her work as a nurse. So she's got quite a generous pension. She's not living sort of paycheck to paycheck. She's doing fine. But she's really looking for growth for herself, but also for her children and grandchildren. And we're seeing this so much now, where this idea of intergenerational wealth always seemed to be for like the top 1% of the population who had access to estate planners and really fancy insurance policies and all of that. But now we're seeing it at regular working class level, where people are like, okay, well, how do we work together to make this work for our dynasty? Even though they're not from multi-millions of dollars, they're just like, how do we just at least remain in the middle class? These are the steps that people are taking right now. Okay.
What's your advice for homeowners with variable rates? I guess they currently have a variable rate.
Brenda, we just had this conversation in our team meeting today, and we're seeing a lot more clients. So until about 3 months ago, the variable rate was off the table. Nobody wanted it. It didn't make sense. Okay. Right now, and in fact, in the next couple of months, we've got several clients who have considered their options, right, Brenda? And we've got at least 2 or 3 in the next couple of weeks who are closing on 5-year variable rates. So they're choosing variable rates. And you might be saying, well, why are they doing that? And it's because a lot of people, rightfully so, believe that we are maybe entering the tail end of this interest rate cycle, meaning that even though rates could potentially pip up a little bit, we're not going to jump 1%. I think I can say that with confidence, right? We're not going to jump 1%. And the next significant move is likely down. And so right now, when you look at what people are choosing between, they're usually choosing between the 2 and 3 year fixed or the 5-year variable. And when you look at the differential, there really isn't much. And they're saying, you know what, they're going to take the gamble on the variable in the idea that maybe that variable will drop within 3 years. And at that point, they can switch out of the variable and go over to a fixed mortgage. So if you currently have a variable, well, I would like to hear a little bit more about your scenario, and maybe, we should have a consultation. But as a general advice, based on just the info I have, maybe hang in there for another year or so, because the next significant move is likely down.
And then another anonymous, my mortgage is up in April. When should we start speaking to a mortgage broker to discuss renewal?
Yeah, definitely now. There is no harm. In fact, we'd encourage all of our clients to talk to us 12 months before renewal. 12 months seems like a long time, but the reason we do it 12 months out is we want to know, in addition to the mortgage, what else is going on in your life, so that when we hit that 12-month mark, we've already factored in maybe new baby, loss of a job, purchase of a car, whatever that might be. Okay. So just I would say the sooner the better for everybody.
Okay. Can we answer that, Carla? Yeah, a lot of variable questions. Here's Warren D'Souza. In 2018, I took a line of credit on my condo to purchase a house. I can't deduct the interest on the line of credit since it wasn't used for an investment, but used for a house that I'm living in. I'm now considering selling that condo and rebuying another for an investment property where the mortgage interest will be tax deductible. What are the pros and cons of doing this? My concern is that I won't be able to qualify for a condo of similar value as I may be over leveraged.
All right. Really good question, Warren.
Yeah.
I won't be able to answer it in this call because I need to know what your qualification criteria is,
Yeah,
income, the price point that you're buying at, selling the condo, rebuying another for an investment property, selling the condo, buying. Yeah, I mean, another way to approach this would be, if you're considering selling it, another option would be simply moving out of it, converting the first condo to a rental. And when you do that property, because you're getting rental income on it, the interest on that property should be tax deductible. Disclaimer, I am not an accountant, but we deal with this stuff every day. And common sense would tell me that would be another option for you to consider. So that question there, Warren, where people have, I always talk about this, we all have different pieces on the chessboard. And Brenda and I, we look at those pieces every day and we go, okay, what's the best way to play this particular setup to get checkmate for you, to get the best outcome for you? So they're the kind of questions that we stick our teeth into every day. So we'd love to set up a call with you, Warren. Definitely book in for a call. Okay, guys. Well, look, thank you very much again for hanging in there. And I really do look forward to talking with some of you. Brenda and I will be talking with you over the next couple of weeks. And do follow us on Instagram. Like I said, it's the best way to get bite-sized bits about what's really going on in the mortgage market, in the real estate market, and the greater economy. So we look forward to maybe connecting with some of you on Instagram as well. Okay, but for now, I'll say good night.